Hi everyone, I'm Sam Fox and welcome to my YouTube channel. Now right here I talk about everything from money, mortgages, finances, properties, buy-to-lets, you name it. I try and simplify the process for anyone looking to start their property journey. Now a few weeks back, some of our viewers were commenting on our videos and one stuck out for me, which was how does car finance payments affect your mortgage? Now I thought it was great, so I'm going to break that down for you. Now before I do, make sure you like and subscribe, and if you've got any comments or any questions, make sure you leave them in the comments below. So let's get to it. So let's start by looking at what types of car finance there are in the UK. Before you get them keys, there are some paperwork you need to sign and it might mean something different on the application. So personal contract purchase or PCP, this is one's probably the most popular. You pay a deposit and monthly payments, but you don't actually own the car unless you make the final balloon payment at the end. So it might look nice and sexy on your payments that it's £300, but in 5 years, you've still got to find 30, 40 grand to pay that off. Obviously it depends on the type of car that you're buying. It might be 5, 6 grand as well. Then we've got hire purchase or HP, and it's similar to a PCP, but the payments are higher, and once you've made them all, then you own the car outright. So the previous one, you have a big balloon payment. This one, it's all going to be cleared off. The next one is a personal loan. Yep, you can go online and depending on the value of your car, let's say it's 20 grand or 5 grand or 10 grand, you'll be able to go to a lender and get a personal loan between 5 years and 7 years. And like the last option, once you've paid them all off and paid the money back to the bank, you own the car outright anyway. And then another common option is a lease or a personal contract hire. So basically you're renting the car for a set term, you return it at the end, you never really own it, and what you tend to find is the company that you work with will just chuck you into another car at that time. You tend to find payments might be a little bit less, and there's sometimes no upfront payment. Sometimes you can just pay your first mortgage payment, car payment, and you get the keys and it's yours and you've got it for 2, 3, 4 years, however long you take it out. Now the mortgage payments. Now, whichever option you choose are gonna have a mortgage. Now, whichever option you choose, I'll get it right this time, you will have a monthly payment that lenders can factor in to your affordability assessments. So we need to know what lenders are looking for. So specifically your income, so they're gonna need to know whether you're employed or you're self-employed, any existing debts, including car finance. They'll take a look at your credit score, monthly outgoings like childcare, maybe subscriptions, and they're also going to look at your debt to income ratio. Now your debt to income ratio is the percentage of your monthly income that goes towards debt repayments, including your car. So let's say you want to borrow 250 grand for a mortgage, but you're also paying £350 a month for a car, then that 350 quid, that might reduce your borrowing potentially by 10, 12, 15 grand depending on the lender. And why? Well, because lenders do a stress test. They're going to check if you can still afford the repayments if interest rates rose in the future. So more monthly debt equals less wiggle room in their eyes now and in the future. So in short, car finance can lower the amount you're able to borrow for a mortgage. And if you do have car finance, like many people do, and you're worried about buying a property, then what I'd say is please don't worry. The biggest mistake we see is people offering on a property before sorting the finances out. So if you do have a car finance, let's work out that affordability and make sure you're fully prepared for the houses that you can look at. Now, if you can't get the mortgage that you're looking for, but you're whacking out 600 quid a month on a fancy car, then that might be the point when you consider getting rid of the car, selling it, getting something more manageable, reducing that payment to say 150, 200 pounds short term to help boost that affordability, manage your finances and get you into that dream home of yours. So just to finish off then, a few quick tips to boost your mortgage application. I look to pay down or clear any existing finance if possible. Paying it down a couple of £100 might mean that credit card's clear, for example. I'd wait until after your mortgage has gone through to take out any sort of finance, speak to a mortgage advisor, and of course, do your own research, check your credit report and make sure everything that you're paid out on is up to date. And that's pretty much it. So car finance, what are you guys gonna do? Are you gonna sell the car or are you gonna keep it? Now, if you've got any questions or any comments, drop them in the comments below. And if you do want to speak to me about anything mortgage related, you can drop me an email. It's sam@ukmc.co.uk. Thanks for watching, hit subscribe, and I'll see you soon.